foreign exchange losses and transition costs to large deals has clearly taken a toll on Zensar Technologies. The IT company saw its profit drop by nearly 40% in the third quarter. Meanwhile, the company plans to exit its non-core business. So will that help it tide over these trying times? Let's find out from the CEO and MD of the company, Mr. Sandeep Kishore. Mr. Sandeep, thanks very much for joining in. First off, could you give us some key highlights of the quarter gone by? And while the revenues looked good enough, it was a pressure that built up on the margins as well as the profit numbers.
Sure, happy to be here and give you a little more detail on the quarter three performance for us. As you called out, actually revenue for us has done quite well. On constant currency, it's 4.5% sequential growth. Close to 18% on year. For our core business, which basically excludes the ROW business and the third-party maintenance business, year-on-year growth actually has been north of 21%. So on the revenue front, we've done quite well. It's largely come on account of some very large deals that we won in quarter three and also in the later half of the quarter two. We won about $200+ million of deal for the first time in a quarter ever in our company in quarter three. And in the previous quarter also we had won $200 million. YTD, we have won over about $700+ million worth of deals. Several of those deals are actually in very, very advanced stages of execution. And the transition cost which comes with execution of these deals, they do impact short-term margin profile. And that's what has happened. And that's why gross margin actually dipped by about 3.8% sequentially, even though on a year-on-year basis, it grew by 4.3%. And that dip in gross margin actually impacted the operating margin as well at the EBITDA level. Profit after tax, you actually called out, we had a Forex loss of about $2.5 million in the quarter compared to the previous quarter, which had a gain of $5 million in quarter two. And hence the delta is about $7.5 million. That's why the percentage looks actually at 40+% or so. But overall on the operating performances, I think we are very focused to execute to the strategy that we have defined, and we are doing quite well.
All right, so two points there. One, you said that the transition costs because of the kind of deals that are in the final stages of completion and execution have impacted your numbers this time. Along with that, you had the base factor kicking in, which reflected on the profitability. So could we assume that this is just the effect that happens this quarter and next quarter will resume back to mean?
Yes, so the core business that we've consistently been calling out now for the last 3 or 4 quarters, we've been operating at about 15% EBITDA range there, which was also there in quarter two. That dipped to 12.5% in quarter three. We are quite committed to actually bring that back in the midterm to the 15% range. So absolutely, yes.
All right. Let's talk about, what the focus now is going to remain for Zensar Technologies and what is your strategy to make sure that you maintain those growth margins for yourself, and what's the approach that you're going to be taking to make sure that, your turnaround playbook goes as per plan?
So, I think it's a great question. We've always maintained that we are a digital first player. If you just take the underlying factors on where the growth are coming in, cloud infrastructure services business has done exceptionally well for us in quarter three. We grew 17% sequentially. That's a phenomenal number, coming around. Almost all the core sectors, which is high tech, financial services and retail, have actually delivered quite well on the revenue performance. We now have over $1 billion worth of pipeline that we are currently fighting and, trying to win. We've won several of those, over the last 2 quarters. We've invested heavily on site. We've added about 1,200 net headcount in the last 12 months. 45% of that net headcount actually is added on site. So investment which is aligned to what really matters to our customers in the digital and the cloud area is where we are executing well. We are fighting, and we have put together a lot of investment. So I feel pretty confident about our ability to stay and execute it, particularly in the core sector, which are financial services, largely insurance, retail and consumer, and the high-tech categories here.
Do you see it getting a little bit difficult in order to replicate the $100 million kind of deal sizes that we have been seeing?
So those deal sizes have actually been coming down. There are far and fewer $100+ million deal. That's just the industry trend. There are several deals between $25 million to $100 million here. In the last 18 months, we've won $200+ million deals, and we've won several between 25 to $100 million deals. In just the cloud infrastructure category business, which I called out earlier, we won 7 deals which are between 10 to 65 to $70 million. So there are a lot of deals which are there in what I call the mid-range sector. There are fewer deals in the $100+ million category. And the return on digital platform that we've built, now we've added artificial intelligence, smart platform, and human experience, I think keep us in a pretty good stead in the competitive landscape.
What exactly, according to you, could be, a clear headwind for you in the near term? While you're talking about replacing those $100 million deal sizes with the smaller ticket sizes, and that's coming your way, do you believe that your larger clients that account for about 25% plus of your revenues, repeat orders coming in, repeat deals coming in from there seem to be a little bit of a hurdle, or that's not a concern?
No, it's not a concern at all. Actually, let me just call that out. The top 20 clients, if you've seen, has actually grown 27% year on year at the end of Q3. That's like a good 10% higher than the overall company average. So as part of our strategy, we've been, deepening our investment and our categories of relationship building and competencies with the clients that really matter for our growth. So the top 5, the top 10, and the top 20, all categories of customers on a year-on-year basis have actually shown significant improvement. Now, we are also finding net new deals because at the end of the day, we have about 100 customers in the $1 million plus category. That number was 81 a year ago. So we've added, give or take, 19, 20 customers in $1 million plus category. We've added 5 into the $5+ million category. So focus for us at Zensar is be the ROD, return on digital partner, for our customers which are large and which have headroom to grow. And that's where we have been executing quite well.
Okay. Just last few questions, Sandeep. Being on what is your plan with regards to your primary 3 verticals and the growth thereof, and also in your exiting of your non-core assets? What is the trajectory there?
So let me take the second one first. We've called out the third-party maintenance business and the ROW business as the 2 non-core businesses because they are at a PAT level margin dilutive to us, and we are exploring all options. So let's just see what happens there. We are committed to find the right home for those businesses, and we are in multiple stages of discussion on those 2 businesses. And that's why a couple of quarters ago, we actually started calling out the core business and the performance in the core business, which has been in the 15% EBITDA range. Traditionally, last quarter it did dip, and we are committed to bring that back. On the core business, which you mentioned about financial services, particularly insurance, we acquired a company which does Guidewire implementation into the P&C sector, and we've done very well. We won 4 new contracts in the insurance, particularly in the US and in the UK market, which basically to digitally enable between $1 to $5 billion insurance companies. So that's a big focus for us in Guidewire implementation in the P&C category. Retail, we are doing omni-channel implementation, largely led by analytics, AI, and experience. And we've done quite well. The last quarter was a bit soft. The growth was about 1.1% on the retail. But with the pipeline that we are looking at, I do believe it will come back up pretty soon. Financial services actually grew by close to 9.6% on a sequential basis. High tech, which is the other sector, is doing quite well. It's grown about 3.7% on a sequential basis. We have some very large clients there. And what is key driver there is about IoT, it's about experience, it's about commerce, and a lot of integration, system integration work that we keep seeing in the high tech and the manufacturing sector. And that's where the competency of the organization that we have built over the last 2+ years, including the Zen Labs focus that we brought, is really helping us, compete in the marketplace.
Sandeep, it was a pleasure chatting with you. Congratulations on your numbers, and hope to see these numbers reverting back. You said 15%. We'll wait and watch for that by the end of the year. Thank you so very much for joining us this morning.
Thank you.